Let's talk about the one thing every American has an opinion on, but nobody actually understands: student loans. Right now, Americans owe $1.7 trillion in student debt. That's more than the GDP of Canada, more than credit card debt and auto loans combined. And here's the part that should scare you. Most of it will never get paid back. Not because people don't want to, because the system was never built for them to. So today we're breaking down how a smart investment in your future turned into the largest unpayable debt pile in American history. Who's actually cashing the check, and why nobody in charge seems to want to fix it. Grab a coffee. This one's a long one, because the story only makes sense once you see the whole chain. Back in the 90s and early 2000s, the pitch was simple. Go to college, get a degree, get a better job, pay off the loan in a few years, live happily ever after. Your parents probably told you this. Your guidance counselor definitely told you this. For a while, that math actually worked. College was cheapish. A bachelor's degree meant something scarce. Not everyone had one. Wages roughly kept pace with tuition, so the loan was a short-term bridge, not a life sentence. Then, something broke. Since 1980, college tuition has gone up over 1,200%. For comparison, overall inflation in that same time, about 230%. Housing, which everyone complains about, around 500%. Even healthcare, notorious for being expensive, rose slower than tuition. Tuition outran everything, every other major cost of living in America. Meanwhile, wages for young graduates barely moved in real terms. Entry-level salaries in a lot of fields today, adjusted for inflation, aren't dramatically higher than they were 20 years ago. So the pay it off in a few years plan quietly turned into pay it off in a few decades, if you're lucky, and if nothing in your life goes wrong along the way. A layoff, a medical bill, a recession, any of it can knock you off the repayment track for years. And here's the twist: almost nobody clocks. The more people were told, just go to college, take out the loan, it'll pay for itself, the more colleges realized they could raise the price, because the loans would always be there to cover the gap. Here's the uncomfortable truth. Tuition didn't explode because education got better. It exploded because the money got easier. In 1965, the federal government started guaranteeing student loans. Good intentions: get more people into college, close the gap for families who couldn't pay cash. But it created a strange incentive loop. As long as the government backs the loan, banks don't really care if you can repay it, and schools don't have much pressure to keep the price reasonable, because the money is basically guaranteed to show up either way. Economists have a name for this: the Bennett hypothesis. First argued back in 1987 by then Secretary of Education William Bennett. The theory is simple. Easy access to federal loans lets colleges raise prices because they know students can just borrow more to cover it. The loan isn't just funding education anymore, it's funding the price increase itself. It's the same logic as handing a teenager an unlimited credit card and being shocked when the bill is enormous. Of course the bill is enormous. Nobody had a reason to keep it small. Now layer on what that money actually got spent on. Ballooning school administration is a huge piece of this. A lot of large universities now employ more administrators than full-time professors, and administrative staff have grown far faster than the teaching staff over the last few decades. You're not paying more for better lectures. You're paying for more people managing the university as an institution. Then there's the facilities arms race. Climbing walls, lazy rivers, luxury dorms with private bathrooms, state-of-the-art student centers. Universities started competing on amenities the way resorts compete for guests, because a nicer campus attracts more applicants, which justifies a higher sticker price, which gets covered by more loans. It's a loop that feeds itself, and the 18-year-old signing the loan paperwork has no idea they're financing a campus expansion. And critically, none of this required anyone to lie or do anything illegal. Every party in this chain was just responding rationally to the incentives in front of them. That's what makes it so hard to fix. It's not a scandal you can arrest someone for. It's a structure. Here's where it gets darker than your average bad loan. If you buy a house you can't afford, worst case, you go bankrupt, the bank takes the house, you start over. If you run a business into the ground, same deal. The business folds, creditors take what's left, and legally, you get a fresh slate. Bankruptcy exists specifically so people get a second chance instead of being crushed forever by one bad financial decision. Student loans don't work that way. Since a law change in 2005, student debt is almost impossible to discharge in bankruptcy. Even if you're disabled, unemployed, or your degree turned out to be completely worthless in the job market. Courts apply what's called the undue hardship standard, and it's set so high that most judges won't grant it, even in genuinely desperate cases. You can walk away from a mortgage. You cannot walk away from this. Which means for millions of borrowers, this isn't debt in the normal sense of the word. It's closer to a subscription you can't cancel. The balance just sits there, compounding month after month, following you through job losses, recessions, marriages, divorces, and decades of life, until eventually wages get garnished directly from a paycheck, tax refunds get seized, or, and this is the part that shocks people, Social Security checks get docked in retirement. Yes, the government can take money out of your Social Security check at 70 years old to collect on a loan you took out at 19. Think about that for a second. A decision made as a teenager, often before the brain has even fully developed the ability to weigh long-term financial consequences, can legally follow a person into their retirement, outliving their career, sometimes outliving their working life entirely. That's not really a loan in the way we normally use that word. A loan implies a defined, escapable obligation. This is closer to indentured earnings, a permanent claim on a percentage of your future income for as long as it takes. Now here's the part that should really make you angry. The federal government isn't just backing these loans, it's profiting from them. Because of how the interest is structured, in many years, the U.S. Department of Education's student loan program has generated tens of billions of dollars in profit for the federal budget. Not cost, profit. The same government that frames student loans as a public good is also, on paper, treating that debt pile as a revenue source in budget projections. Then there are the loan servicers, the private companies that manage repayment on the government's behalf. Names you've probably seen on your own statements. These companies get paid based on servicing volume, largely regardless of whether you successfully pay off your loan or not. There's no strong built-in incentive for them to proactively help you find the cheapest repayment plan or the fastest path to zero, because their revenue doesn't depend on your success. It depends on your loan staying active and in their portfolio. Multiple servicers have faced lawsuits and multi-state settlements over allegations of steering borrowers into more expensive, longer-term repayment options, like extended forbearance, instead of the income-driven plans that would have actually reduced what borrowers owed over time. Forbearance sounds helpful in the moment because it pauses payments, but interest usually keeps accruing, so the balance can grow while you think you're getting relief. Then there's the for-profit college sector, which took this entire incentive structure to its most extreme conclusion. Several major for-profit chains were later found by regulators to have aggressively recruited students, including veterans and low-income applicants, specifically because they qualified for federal aid, often promising job placement rates that didn't hold up. Some of these institutions collapsed entirely, leaving students with worthless credits and full loan balances. No diploma, no refund, nothing to show for it except the debt. So line up the incentives. The lender profits from interest. The servicer profits from the loan staying alive. The school, public, private, or for-profit, profits from tuition covered up front by loan disbursement. And the only party in this entire chain with zero structural upside is the 25-year-old who just wanted a degree and a shot at a better life. Here's a detail that gets buried in most of the national conversation. This crisis doesn't hit everyone the same way. Black borrowers, on average, carry significantly higher student debt loads 4 years after graduation than white borrowers, driven partly by wealth gaps that mean less family support for tuition up front, and partly by disparities in generational wealth built long before anyone applied to college. Women hold roughly 2/3 of all outstanding student debt in the U.S., despite being the majority of college graduates, partly because of the gender pay gap making repayments slower, even with similar loan amounts to men, and graduate degree holders, especially in law, medicine before residency income kicks in, and some master's programs, can carry six-figure balances that dwarf undergraduate debt, because Graduate Plus loans have essentially no federal borrowing cap. If a school raises the price, the loan just expands to match it. There's no ceiling forcing a natural check on cost. This isn't a story about one type of borrower making bad choices. It's a story about a system that produces wildly different outcomes depending on the wealth, race, and gender you started with, while charging everyone through the same debt mechanism. This isn't just a young people's problem. It's dragging on the entire economy, in ways that eventually touch people who never took out a student loan themselves. Student debt is now one of the most cited reasons millennials and Gen Z delay buying homes, delay having kids, and delay starting businesses. When an entire generation is sending hundreds of dollars a month into a balance that barely moves instead of into savings, home down payments, or small business investment, that's real money not circulating through the broader economy, not funding new businesses, not funding home purchases that support construction jobs, not funding the next generation of consumer spending that the economy generally depends on. Some studies estimate the drag from student debt on the housing market alone accounts for a meaningful share of missing first-time homebuyers over the past decade. Fewer first-time buyers means a slower-moving housing market overall, which affects sellers, realtors, and builders too. It's a quiet tax on an entire generation's future, and it's one of the reasons the classic milestones of adulthood, buying a house, getting married, having kids, now happen years later on average than they did for previous generations. This isn't just a vibe or a cultural shift. A meaningful chunk of it is simple arithmetic. Less disposable income means slower life milestones. Government attempts to fix this have been messy, to put it generously. Broad loan forgiveness plans have been proposed, partially enacted, challenged in court, and in some cases blocked entirely, leaving millions of borrowers in limbo for years, unsure whether relief is actually coming or whether they should keep paying as. Income-driven repayment plans exist, which cap your monthly payment based on what you earn, a genuinely useful idea in theory. But the fine print often means the balance still grows, because the capped payment doesn't even cover the monthly interest. Some borrowers make payments faithfully for years and watch their total balance go up, not down, which is a uniquely demoralizing experience, doing everything right and still losing ground. There have been proposals for tuition-free community college, caps on graduate loan borrowing, employer-sponsored repayment benefits, and interest rate reform. Some of these have gotten traction in specific states or specific employers. None of them have been implemented at a scale that meaningfully shrinks the $1.7 trillion total. The honest answer? There is no clean fix yet. Any serious solution, mass forgiveness, tuition price caps, interest reform, bankruptcy law changes, creates a new set of problems, whether that's cost to taxpayers who didn't take out loans, moral hazard concerns, or political backlash from people who already paid off their own debt and don't want to fund someone else's forgiveness, which is exactly why, 10+ years into this being a mainstream headline political issue, we're still stuck with the same trillion-dollar pile, just bigger every year. At the end of the day, this isn't really a story about irresponsible 18-year-olds who should have known better. Most of them were teenagers, following the exact advice every adult in their life gave them. It's a story about a system where every incentive for schools, lenders, and servicers points toward more borrowing, not less. The people making the decisions about tuition prices and loan structures aren't the ones carrying the actual repayment risk decades later. If you're currently holding student debt, the takeaway isn't "you failed" or "you should have known better." It's understanding exactly how the system is structured so you can make the smartest possible moves within it. Which repayment plans actually reduce your balance instead of just keeping you afloat? Whether refinancing makes sense for your situation, and what forgiveness programs you might actually qualify for right now, not 5 years from now. And if you're about to make this decision for the first time, or you're a parent watching a kid head into it, the real lesson from everything we just covered isn't "don't go to college." It's understand exactly what you're signing. Understand that the price tag was never really tied to the value of the education, and go in with eyes open instead of trusting the system to have your best interest at heart. It doesn't. It never really did. If this broke down something you'd never seen explained this clearly, hit subscribe. That's exactly what this channel does every week.